Okay, let's dig into this. We're doing a deep dive today on what looks like a classic market paradox. We're talking about Academy Sports and Outdoors, ticker ASO, and their Q3 2025 earnings. You have a company in a really tough consumer space, but when they drop their numbers, the stock just absolutely exploded.
It was a really fascinating reaction. The stock jumped, 8.6% on double its normal trading volume just right after the release.
Oh.
So you saw a lot of capital just flood into this name. Our mission for this deep dive is to really pinpoint what operational metrics and, what stories they told that convinced investors that this company has found a way to win, even with these huge macro headwinds.
Right.
We really have to focus on where that profitability is coming from and if this shift in their customer base is, durable.
Let's start with that top line snapshot, because this is really where the puzzle starts. It was a tale of two metrics, for sure.
Yeah.
Revenue was soft, but the earnings were strong.
Exactly. Net sales came in at about $1,384 million. That was a slight miss.
A miss, okay.
Yeah, the consensus was looking for closer to $1.4 billion, so that's a 1.3% shortfall on the top line, which, at first glance, that suggests consumer weakness.
But then you have the profit side, which was the clear, undeniable winner. Adjusted EPS, earnings per share, hit $1.14.
A huge beat. The street was expecting something around $1.06, maybe $1.07.
So we're talking a 7 or 8% beat on the profit line. And importantly, that's 16% growth over last year.
And this immediately tells you what the market actually valued. Investors just looked past that modest sales miss, that $16 million shortfall or whatever, because they were so focused on the strong earnings beat and the powerful margin story underneath it all.
So it's a shift in the narrative.
A fundamental shift. It's no longer about just hitting sales targets no matter what. It's about structural profitability, operational efficiency. The market is buying the quality of the earnings, not just the volume of the sales.
That structural change has to start with comparable sales, or comps. The reported number was a decline of minus 0.9% for the quarter. Slight.
Now, that's not positive, obviously, but it's a huge improvement from the minus 4.9% they had in the same quarter last year.
And if you look under the hood of that comp data, that's where you see the real operational health. Total transactions were actually down 4.1%.
So they're still struggling a bit to get people in the door.
They are, especially with their core consumer. But the average ticket size, so what people are spending once they're inside, was up a really strong 3.3%. This suggests, pricing power, but also a better, higher margin mix of products ending up in the cart.
And this is where management really helped spin the narrative on that negative comp figure. They pointed directly at one category, ammunition and hunting, and called it a massive drag.
That 130 basis point drag is the key piece of context here. Management said this was all because they were lapping that massive kind of non-recurring demand spike they saw last year. The pre-election run-up in that category. It was a one-time boom.
So I have to ask, is that just a convenient excuse or is this a genuine one-off thing? I mean, a 130 basis point swing from one category is huge. It seems pretty genuine, mainly because last year's demand was just so off the charts high. If you just strip out that one specific headwind, and remember, 130 basis points is 1.3 percentage points.
Right.
Comp sales for Academy would have actually been positive. They would have been up about 0.4%.
And that completely changes the story.
It flips the entire top-line narrative from soft demand to operational strength that was just masked by a cycling event.
That makes a lot of sense. But the real star of the show, the reason for the stock jump, it has to be the margin expansion. How did they pull that off in this environment?
They delivered a massive gross margin expansion of 170 basis points year over year, hitting 35.7%.
So that's a 1.7% jump. That's significant.
It's huge. And if you break it down, 130 basis points of that came from merchandise margin. That means they were managing inventory much cleaner, they weren't relying on deep promotions, and they had real pricing discipline, even while they were absorbing some higher tariff costs.
And the other 40 basis points?
Well, about 30 of that came from favorable logistics costs. They were lapping some of those port strike issues from last year that didn't repeat. And they also said they got another 20 basis points just from lower shrink, which is, retail speak for theft and inventory loss.
Okay, now what about SG&A expenses? Selling, general, and admin. Those were up 120 basis points as a percentage of sales. Usually, rising costs would spook investors.
And that's a fair point, but management gave some really critical context here. They stressed that the entire 120 basis point increase was due to strategic offensive growth initiatives,
Like,
specifically new store openings and the tech investments they need to support that growing e-commerce channel.
so they're saying this isn't defensive spending, it's an investment in the future.
Precisely. And they said if you strip out those growth-related costs, the core SG&A would have actually leveraged by 40 basis points. What
Okay.
that means for you is that their underlying operating costs grew slower than their sales. It's the definition of efficiency.
Okay, that makes sense. So let's look at where that money's going. The three growth pillars. First up, the new stores.
Right. They opened 11 new stores in Q3. And the really fascinating data point here is how fast those recent stores, the 2023 and 2024 classes, are maturing. They started off comping in the low single digits, then mid singles, and now in Q3 they're comping in the high single digits.
Oh, that fast acceleration.
It's a major predictable tailwind for the whole company.
The second pillar, digital, is also accelerating like crazy. E-commerce grew 22.2%. That's the third straight quarter of double-digit growth.
And penetration is now over that key 10% threshold, hitting 10.4% of total sales. They're saying this is all because of their tech investments like the RFID rollout
Yeah.
and this symbiotic relationship with their new physical stores.
Okay, wait, let's just clarify that. What does an RFID rollout actually do for someone buying online?
It's all about reliability. RFID tags mean they know exactly where every single item is in the store, with almost perfect accuracy. So for buy online, pick up in store, or BOPUS, it's way more reliable and faster. The new stores are basically becoming mini fulfillment hubs.
A unified retail strategy. And the third pillar, the brand upgrade.
Yes, specifically Nike and Jordan. Management said that in the stores where they rolled out an expanded selection of those two brands, comps grew in the high single digits.
That's how they get that higher-end consumer.
It is, and they're planning to roll out more of that premium footwear and apparel assortment in more stores all through 2026.
We've established the financials are strong, but the real durability here depends on who is actually spending the money. So let's talk about the customer base, which management called de-risking the consumer profile. This sounds like the K-shaped economy in action.
This is probably the most important long-term story. Management said that high-income households, so people earning over $100,000 a year, now make up roughly 40% of their total sales.
40%. That's a big jump from what, about a third not too long ago?
It's a meaningful jump, and traffic from that high-income group grew in the high single digits this quarter.
So is this durable? Are these consumers permanently choosing Academy, or is this just a temporary trade down while inflation is still a problem?
It's probably a mix, but the durability is in the product. They're getting a 2-for-1. One, that high-income consumer is seeking value by trading down from specialty retailers. And two, Academy is meeting them halfway by offering that better selection like the Nike and Jordan stuff.
The value proposition plus the brands they want.
It's a powerful combination.
What about the other side of that K, the lower income customers?
The lower income groups, so under $50,000, they're still showing traffic declines in the mid-single digits. That pressure is very real. But management did say that the pace of those declines is slowing down compared to the first half of the year, so the bleeding is slowing.
So where does this take them next? Looking at their guidance and the store pipeline, they seem pretty confident.
Oh, absolutely. They confirmed plans to open 20 to 25 new stores in 2026. And here's a little strategic detail. They're putting 80% of those in legacy or existing markets.
Doubling down on what they know works.
Exactly. High ROI growth where brand awareness is already strong.
And they mentioned a really unexpected long-term tailwind, the World Cup.
Yeah, they explicitly called out the 2026 World Cup, noting that games are happening right in ASO's core footprint, like Dallas and Houston. They see this not just as a short-term jersey sales bump, but as a multi-year catalyst for soccer participation, driving sales of equipment and gear for years.
And looking at the updated full-year guidance, they tightened the comp sales range to -2% to flat, still a bit soft,
Yeah.
but they raised the key profitability metric.
Raised gross margin guidance to between 34.3% and 34.5%. That's the confirmation the market wanted. The Q3 margin gains are sustainable.
And EPS.
The adjusted EPS range is now $5.65 to $6.15. The midpoint is technically a little below the prior range, but that's because they're being proactive and modeling in the higher SG&A for growth and those tariff pressures.
Conservative on the top line, aggressive on the spending. What about capital allocation? Do they keep buying back stock?
They actually paused buybacks in Q3. It was a tactical move to manage inventory and cash after they prepaid some tariffs. But they confirmed they're resuming buybacks in Q4, which signals a lot of confidence in their cash flow.
Okay, let's tie a bow on this. Why did the stock rally 8.6% on a sales miss?
It boils down to three things. One, the big EPS beat. Two, the powerful gross margin expansion, which proved they have pricing power. And three, the acceleration in their growth channels, those high-comping new stores, and that 22% digital growth. Investors bought the profitability story.
But even with all that good news, we saw some unusual options flow, suggesting some institutional caution, right?
We did. Even with that stock pop, options data showed a huge spike in put volume, about 310% of normal. There was a big block of April 2026 $40 puts that traded.
So some big players are hedging.
Yeah, it signals that while some institutions bought the stock, others are buying protection, hedging against the risk that comps don't stabilize or that the macro environment really hits that low-income customer next year. It's a cautiously bullish view.
And that skepticism takes us to our final segment. This is not financial advice. We are now presenting an outrageous but plausible trade idea to our imaginary investment committee rooted in today's earnings data.
Okay, the trade is this. We recommend going long ASO common stock, but you fund that position by selling a large block of out-of-the-money puts. Specifically, you target that same April 2026 $40 put block where we saw all that volume.
Okay, walk us through the thesis. Why sell protection at $40 when the stock just had a huge rally?
The thesis is that ASO has fundamentally de-risked its customer base. That shift to $100 plus households making up 40% of sales, that provides a stable, resilient floor against future macro shocks. On top of that, management has proven they can structurally expand gross margin. That ensures profitability even if sales stay flat. The Q3 beat shows that the company's operational floor is way higher than that $40 strike price implies.
So you're arguing that the $40 strike, which the market seems to think is a major risk, is actually just a big premium for fear.
Precisely. Selling the puts generates income, which lowers the net cost of your stock. You're getting paid to bet on something the operational metrics already suggest. That ASO's floor, driven by their strategic execution and their new, wealthier customer, is well above $40.
A confident pitch. Okay, to recap our deep dive, ASO delivered a quality beat driven by structural profitability and momentum in new stores and digital. This strongly outweighed the sales miss. And the shift toward that $100,000 plus customer is the key long-term narrative.
It is. And that leads us to our final provocative thought for you to think about heading into 2026. Management is doubling down on new stores in their best, highest ROI legacy markets. So question is, given that these new stores are already comping in the high single digits, can they, combined with that accelerating digital channel, finally provide enough of a tailwind to push the entire company's comparable sales into sustained positive territory in 2026, even if macro pressures on that low-income consumer stick around?
That sustained positive comp. That is the inflection point everyone is going to be watching for next year.
Thanks for joining us for this deep dive.